Hello and welcome to Crack the Code, a show that aims to educate you about making informed investment decisions. I'm Sumaira Abdi, and this week we take a close look at the IT sector. It's an industry that has put India on the world map.
The information technology sector, which contributes 7.5% to India's GDP, has two major components: IT services and business process outsourcing or BPO. Both segments generated a revenue of $147 billion in 2015, with exports alone constituting $99 billion. These numbers have made it possible for India to emerge as the world's largest sourcing destination for the IT industry. Not only is this largely responsible for the country's economic transformation, it has also changed the perception of India globally. The country's cost competitiveness in providing IT services is 3 to 4 times more economical compared to the US. Indian IT companies have also helped global clients save a whopping $200 billion over the last 5 years. Recognizing the huge pool of talent and skill available in India, several global IT firms are setting up their innovation centers in India. The industry, which provides employment to over 10 million people, now seems to be at an inflection point, moving from enterprise servicing to enterprise solutions. So will the sector continue to hold sway, or is its sheen diminishing?
And with me now, we have Rahul Tiwari of ICICI Securities, Chaitanya Shahare from IFL Markets and Trustline Holdings, Aruna Giri. Gentlemen, thanks very much for joining in. So it's the IT stocks, the entire bunch that we're looking at this week. All the way back from 1999 when the IT index was actually introduced, it's been like a rock, right? But off late, it's fallen out of favor with the market, right? What's actually gone so wrong for these stocks?
So I think if you really look historically, the IT index has outperformed the broader market. The narrative has changed in the last 2 to 3 years. And I think the story that is coming out is that wage arbitrage, which is the common denominator that benefited all the companies out there, is not a powerful proposition for the Indian IT services companies to take to their customers. So the feedback from the customer is, are you interesting partner for us on the digital technologies? Do you have cloud solutions? Things like that add value in the current context when the entire ecosystem is digitizing itself. So I think that's where the challenge is coming for growth.
Okay, fair enough. But, to the point of being near wealth destroyers, right? Is it just like a temporary disruption, you think, Chaitanya? Or is it more that this is the way things are going to be? Is it just a blip in their cycle?
So what I would say is the model which we worked on 15-20 years back has changed. So the complete industry has changed. So it's a world of changing technology, fast changing technology. Earlier, where people were spending on application development, now they are moving to SaaS or AI or robotics, wherein the CIO, Fortune 500 CIO, wants to spend more on SaaS rather than application development. So they want to move more into analytics, more into customer facing, into a technology which will help them generate more revenues or reach out to those customers, wherein I will grab them, I will get them to hook to my services or products and generate more revenue. But Indian companies, the model has been the same. I want to give a service for software development and then manage them.
Just to add to that, the question which we are asking is whether it is the headwinds are structural or cyclical. Bit of history would help. Now, if you go back how the industry evolved, a lot of it came from the increase in offshoring and also the traditional IT spending, which is more on legacy ADM services. Now, what's happening now is the share of offshoring is stabilizing, and you are seeing a very visible decline in IT spending, traditional IT spending. So with these two levers off, the large players are finding it difficult to grow. Now with muted growth in US economy now, GDP growth, the pressure on IT spending will persist, which means they will struggle to grow. And with add to that, the deflationary impact of automation, digital and cloud, it's very difficult to build a bullish case for IT. So structurally it is weak. From here on, what will happen for the large players is that it is going to be market share gains, the game of market share gains. The guys who have invested well on digital, the company which has got management which is good in execution, which has got scale, will be able to capitalize on these opportunities.
Okay, so you mean to say that the plain vanilla companies as such are going to get gobbled up, or they're going to just fizzle out on their own? There's no scope left for them, right? What if a person was holding something like that in their portfolio? Is this now the time to exit? Because in any case, he's not going to get a good exit opportunity for the next few years. What does that person do?
So I would say every 5 years or every 10 years, there is always a disruption. Okay, when I talk about microeconomic factor, even the technology development, they change over a period of time. So whenever a new technology comes into picture, your margins will get affected.
Fair enough, but what's the takeaway for the investor then?
I think if you look at it from a value investing point of view, probably this is a great time to invest because the valuations, do not seem that expensive, and some of the large companies that were growing extremely fast have mellowed down. And that gives a very interesting entry point for somebody who wants to hold the stock for some period of time, because the response from some of the large IT companies has also been very, very interesting. I mean, they're acquiring companies, they're investing in automation, they are running innovation labs with their customers. So they're preparing themselves, for that big change. If you look globally, a company like Accenture, I mean, their digital business is sizable, close to about $7 billion, growing at 30%. So the opportunity is there. Just the Indian IT services companies are adjusting to the new reality.
Rahul, you're a brave man, and I'll tell you why you're so brave. Because you're taking this contra bet in the week that we've seen Trump dial up the rhetoric on, job exports. So perhaps a person is now investing with the hope/fear that he could be the next president for the next 4 years. There's Brexit, there's increasing worries in the BFSI space. Should the investor really be that brave?
The dynamic on the industry is that talent is more important today, and the depth of the talent in the US economy or any other developed economy is not all that great to basically power their digital strategies. The world will have to rely on companies like Infosys that are in countries like India. So yes, I think the regulatory action or the political backlash will impact the Indian IT services companies, but some of these companies are already preparing themselves with on-site resources. They want to be more local. So the cost will go up a little bit of doing business, but the value proposition is not going to vanish.
I would say agility in the company would be most important here, because it's a fast changing environment. Even if there is a BR exit, there is Trump coming in, how soon you can change your model to a new, the outdated model to a new model? Or how soon you can actually redeploy your resources, key resources, into a new project or new stream of business. That will be a key factor here for investing into these stocks.
Okay, so let's talk about companies then, right? So we've seen Infosys actually keep the leadership mantle for a goodish number of years, right? There was a lag in the middle where we saw TCS sort of overtake them. TCS too over there, it looks now like the valuations are peaking, right? Not a lot of brokerage houses are very, very bullish on how things could shape up in the future. Which is going to be the next leadership stock? I mean, if someone was to look at the frontline IT space, what would be that one stock? Could something like, say, a Tech Mahindra or a Wipro actually scale themselves up to that quality?
When you look at the larger players, it is a challenging times. It's not going to be easy because their size is very large and the digital market is small. So from here on, as I see it, it is going to be market share gains. So it is going to depend on which management is much more efficient in execution, which management has got much better scale. So when you look at it from that point of view, it looks like TCS and Infosys has got a kind of an edge when it comes to market share gains. Tech Mahindra probably is one vertical dependent. A lot of their business comes out of telecom. Though they have gone through bad times, they are in a recovery mode. Of course, that stock would recover when the sentiments in telecom improves. But I'm not sure whether they could compete and overtake people like TCS and Infosys.
So my bet will still be with the large cap companies because the mid cap companies are more nimble, but at the same time their earnings might be more volatile because of the customer concentration issues Also, the large cap companies are better positioned with their balance sheet to invest in these emerging technologies, and also they benefit from the fact that they can attract better talent. So I think it's a mixed bag to a certain extent.
Is there nothing in the mid-cap or the small-cap space? I mean, for a value investor, right? So they've already missed the boat on the bigger companies, right? If they were to go out today and look for something to invest in, perhaps for the next 15, 20 years, is there anything that strikes you from the smaller companies?
So mid-cap, when I talk about, they are very agile. Okay, they are small, but when I talk about, even the model is not differentiated. The people or the companies which are the top management differentiating their model and investing into the new technology, investing in the digitization. When I talk about digitization, India is talking about smart cities, digital payments, digital economies. So companies who are investing into such new stream of business, yes, it's a risky stream, but people who will get into such streams, new streams, make new business vertical out of nothing, which is a big space is there, but nobody is catering to. So this mid-cap might be a multi-bagger over a period of time. But yes, choosing those stocks is most important as of now. So we can't just say, okay, this company or this management is good, so they are doing well and they will come up as a multi-bagger over a period of time. No. This will feature in next 1 or 2 years. We will come to know, okay, the management is putting a lot of efforts. Even the mid-caps today, they are doing small steps here and there. But no concrete step is happening wherein I say, yes, I will actually help government set up a digital economy.
In mid and small cap, it is also important not to paint all of them with a single brush.
Yeah.
There is there are companies which are not into services, which are building very strong product stories. There's a company like Intellect, which is building a very strong story on consumer banking and core banking product solutions. Similarly, we have a company which is based out of Gurgaon, Nucleus Software, which has got a very leading, robust platform for lending solution. So there are differentiated stories within small and mid cap which can create wealth and value over a long period of time for value investors.
One would have hoped for more diversity in the IT or the technology sector, and there's just a few of these companies. So, for example, on consumer internet we have InfoEdge, which is a fine example. In security services we have Quick Heal, and with the private funding which we've seen from the VC community and the private equity funds, one hopes that there'll be more interesting names that'll come into the capital market.
So it's good you've raised this point of diversity within the sector, right? Because even within what's existing now, hardware, software, KPO, BPO, what's the next leg of growth going to be built on?
If you look at the BPO space, I think that's where the robotic process automation solutions are really, basically attacking the core of the margin profile of these companies. So I wouldn't go there. As far as the hardware companies are concerned, hardware is a commodity today. So if there's a company that addresses hardware with embedded software and applications, yes, that's an interesting space to go to. Domestic, I think localization of manufacturing might be a good story to pursue, but we do not have any examples of that in the capital markets. So that leaves us with the software services space, where most of the investing would happen.
Where everybody sort of comes
Everybody
back
is
to.
there.
Okay.
There is a space which is very interesting, is an IoT space.
Yeah.
Internet of Things. There's a very growing. It's a growing space. Currently, it's very small. There is a consumer IoT and there is a industrial IoT. Now there are companies like Wipro and HCL Tech, which has traditionally been evolved from the hardware business. They have those skills to develop a very strong business in IoT. So that could be one emerging story within the large players who have got hardware background.
Okay, so now we've figured out how to select the stock, right? You remain invested for whatever term suits you, perhaps for longer if you're a value investor. What is the key to look at while exiting a stock in the IT space? How big of a headwind is something like a currency or regulatory overhangs in other economies? What should be that one key trigger for selling, or should it just be when your time is up, you're done with the stock?
So I believe such triggers can't be defined as of now, because it's a fast changing world. When you say 20 years back what Infosys did to EDS and HP by giving a lowest cost for software development, someone can come up, a small, even a startup may come up and say, okay, this is my product and services which I'm selling SaaS over cloud, I'm giving AI, I'm giving robotics, and all this stuff can come up and say, okay, they can actually wipe out the margins. So there is no as such a trigger when you can say, okay, I should exit. But yes, you should understand what's going in the world. In future, probably there would be different triggers wherein I can take out the money or invest in certain sectors.
Okay, fair enough. In that case, how does one read the guidance picture by a company, right? So once they give a guidance in their quarterly meet, that's written in stone for the market, right? If they were to backtrack on their guidance, if they were to raise the guidance, what does that do in terms of a trigger for the stock for a person who's already invested in that stock?
So I would be an investor for the long term because the volatility is just going to increase in the quarterly earnings. The reason being, companies are investing for the future. They're reskilling their workforce. They are acquiring companies overseas. And that adds to a lot of noise. And sometimes the earnings, guidance is missed. So this is a transition phase where the investor should really, be looking at the longer term picture. And really look at, the quality of the management, quality of the customer base, what are the strategic actions that the company has taken to prepare themselves for this transition period. I think that's important.
If the long-term picture outlook is stable and if the prospects are strong for the company, the investor who is already invested should look at that as an opportunity to add positions. Because we have seen historically, whenever there has been a sharp correction because of short-term guidance issues, it has always been an opportunity for long-term value investors.
Okay, so in that case, once you get the P&L of a company, what would you look at first, right? What's the most important metric? Would you look at dollar revenue? If that's okay or doing better, everything else can take a back seat?
The primary importance which we give is for the business profile. So the first factor we look at is in terms of technology practices. If you take an IT company, it has got different technology practices. It has got a traditional ADM practice. It has got IMS, which is recently growing strong. It has got BPO. So different practices. The recent ones are digital and cloud. So each of these revenue profiles are different. If you take ADM practice, it's very sticky. It's annuity based, so which is more predictable. If you take an enterprise application practice, which is more like project-based revenues, so it's not sticky. So overall, when you evaluate the practices, you get to know how the revenue profile for the company is. Similarly, you look at the industry verticals, in terms of BFSI, telecom, E&U, or CPG, so retail. So each of these verticals got a different growth profile. For example, currently E&U is going through a slowdown. BFSI is going through a slowdown. Your telecom is just coming off recovery. Your CPG is all right. Healthcare is a bit of a problem because of M&A. So based on these verticals, you will be able to assess what kind of growth profile you can ascertain. Then you move on to financials and see the return ratios, margin profile, cash flow generation, volume growth, and the trigger. You could have a leverage from utilization, hiring. So all those factors you combine and see what is the business is worth, and then look at what the current price, whether does it give margin of safety for the kind of business it is worth. If there is a substantial margin of safety, then you go ahead and invest. That's what the long-term investors should look at.
All right. There's a fear also in the market that perhaps NASSCOM could lower their FY17 guidance as well, right? Given the way the companies have lowered their outlook for their own businesses. Would that also be a trigger then to buy for a long-term investor?
I think the NASSCOM guidance has to be looked along with the global estimates for the growth in the industry. So the industry analysts are saying that the growth is there. If at all, technology is integral part of every industry today. So it's going to be a $3.5 trillion technology spend by 2020. 80% of the incremental spend is coming from digital technologies. So, if Indian IT services companies are not going to benefit from that, that's more of a overall challenge for the space and the transformation which is happening. But I wouldn't be surprised that in the short term there would be an adjustment, but the long term guidance, I don't think that would fundamentally change. Yes, short-term adjustment to prepare for the long-term view here.
Just to wrap it up, what's the advice for IT investors? I mean, anything that they should look out for, any challenges in the next few years or opportunities as you guys see them?
In my view, opportunities always come in a downturn. IT sector currently is going through such a challenge, some of which is structural, some of which is tactical. But value could emerge in large players as well as in small and mid cap. Large players who has a potential to increase market share will benefit out of this downturn, so you should look out for such companies. Small and mid cap will look for differentiated stories. People who are in the product side, who are building good product in a very niche space, they have very, very strong prospects. That's where the investor should look out.
I don't know, you've just taken the safe route because you've given one dish for everybody, right? So you've recommended a Gujarati thali for the investor. Somebody will find everything over there. What about you, Rahul?
I would say, just don't look for scale, look for capability. And that's a very difficult thing to do. But I think that's where people should be spending time.
I would say IT sector is going through a transformation phase, and here probably a strategical move or a tactical move by the top management should be looked upon, and how they are bringing in differentiation, how they are doing or reskilling their own workforce, learning and relearning, and then again how they are actually creating new business streams or new industry verticals. This should be looked upon by even the small cap, mid cap, or even the frontline players. If the top management are making a strategic move to such streams, this should be looked upon for a longer term.
All right, so there's been a lot of learnings from this show for myself, as I'm sure for our viewers. Gentlemen, thanks very much for your time and for coming to our studio this week. Thanks very much.
Thank you.
All right, that brings us to the end of this show. Do stay tuned as we continue on our quest to decode and analyze so that you can invest wisely. Until next time, thanks for watching.